Hello, I'm Mary Kurzweil with the CattleFax Closing Bell. This week's Closing Bell is brought to you by VitaFirm. The latest USDA hogs and pigs inventory report was released this week. Overall, the report was bearish, showing total hog supplies larger than a year ago across all market hog categories. The report also revised previous reports to show larger pig crops from December through May, which helps explain the larger than expected supplies that we've seen thus far. Market hog supplies should be at or above year-ago levels from now through the first half of next year. This was unexpected as previous reports have shown smaller farrowing intentions and the breeding herd has continued to contract. The breeding herd was down 1.2% from year-ago levels and at the lowest it has been since 2016. The cull rate was also strong at 14.7%, the strongest rate since 2012. This is no surprise, with poor to negative margins for hog producers in the past year, forcing some contraction. Sow and boar slaughter has also supported this, up about 7% compared to year-ago levels since May. The big surprise came in a large improvement in efficiency, with a 4.2% increase in pigs saved per litter from June through August. This more than offset the 3.5% decrease in farrowings. Part of that is from improvements in reproductive disease compared to a year ago. The other part of that is closures and contractions this year were reportedly targeted for less efficient facilities. The combination of that has meant a record high productivity level and says hog supplies could continue to be stable even with a smaller breeding herd supply. Turning towards this week's markets, the looming threat of a government shutdown has been seen across most futures markets. The uncertainty that this introduces creates a risk-off environment and also causes a lot of volatility. If the shutdown does occur, that will likely be negative to the futures with uncertainty on the amount of time that it'll last and its impact. Cattle markets are not immune to this, with most live cattle futures contracts declining around $2 to $3 this week. Futures contracts, or feeder cattle futures contracts, which are typically more volatile, have moved around $7 lower across most contracts. Still, the fundamental market situation has not changed, with supply still tight and demand strong. This means that short-term cash will likely outperform the futures and the basis will narrow. Fed cattle saw moderate cash trade this week at 184 to 185 in the north and 183 in the south, which is mostly steady with last week. Thanks for watching, and remember to visit CattleFax.com to become a member and receive the latest market news and analysis.